Did you know measures of uncertainty about U.S. Short-term interest rates have hit decade highs?
Wow.
It's true. That's according to the Federal Reserve.
Huh.
And it really highlights something that every institutional investor is dealing with. We have to look beyond those traditional economic indicators,
Mm,
especially when it comes to inflation.
absolutely. And today's deep dive is all about those signals that often get overlooked, the signals that the really smart institutional investors like yourself pay close attention to.
Right.
We're going to be using research from a whole bunch of sources today. The
Yeah.
Federal Reserve, of course, economic think tanks. We've got investment powerhouses like BlackRock and the Motley Fool. And we're even going to delve into a bit of behavioral psychology
Oh, cool.
to try to understand how these savvy CFOs are making their moves.
Yeah, this is going to be fascinating. We're going to look at how companies are allocating capital, hedging risk, and even using market cycles to really boost their profitability.
It's a lot to cover.
It is.
But let's start with that Federal Reserve research you mentioned.
Okay.
So it shows that while U.S. families actually saw, some broad improvements in their finances between 2019 and 2022, measures of uncertainty about interest rates have skyrocketed in the same period.
Yeah.
And this points to, this deep uncertainty about where inflation's going, how the Fed's going to respond to it, and the perceived risks to economic activity.
So it's not just about the raw numbers.
No.
It's really about how people are feeling about the future.
Yeah.
And how that's affecting their decisions.
That's exactly right. Sentiment is just as important as the data itself. And as an institutional investor, that means you need to understand both.
Okay, so let's pull back the lens a bit and look at the global landscape.
Okay.
The World Economic Forum is highlighting deglobalization as a driver, potentially, of sustained inflation. So we're talking trade wars, a shift towards protecting domestic jobs, all of this disrupting global supply chains.
Yeah. Right. And all of this, if we zoom out even further, you can see how it creates this really challenging environment for CFOs. Disruptions plus geopolitical tensions, this can lead to persistent inflation. And that impacts everything from where they put their resources to how they manage their portfolios.
It's like playing a game of chess where the rules are constantly changing.
I like that analogy.
Thanks.
And speaking of adapting to change, we saw something really interesting in a recent Deloitte Insights survey.
Oh, yeah.
Yeah. It seems that companies that are embracing generative AI are actually showing much more confidence in their ability to handle whatever inflation throws at them.
They're not just talking about it either.
Mm.
These companies are putting their money where their mouth is. They're allocating significantly more resources to AI than other companies, and they're seeing faster, more significant transformations within their organizations.
Right. And that suggests that for CFOs who are struggling with where to put their resources, investing in AI might be what they need to stand out and soften the blow of inflation.
Now, this next one might surprise you. Psychology Today suggests that remote work could actually help reduce inflation.
Interesting.
Yeah. Their studies indicate that remote workers tend to be more productive. Companies save on overhead costs. So this could potentially lead to lower wage growth and reduced consumer spending.
However, despite this evidence, many CEOs seem to be resisting the switch to remote work.
Yeah.
This is where things like cognitive biases come in, belief bias and confirmation bias. These things make people cling to what they already believe, even when the data says otherwise.
So even in the institutional investing world, human psychology plays a role.
It does.
Data is important.
Mm,
But how people interpret and react to that data is just as important.
absolutely.
So let's talk about hedging strategies.
Okay.
Traditional hedges against inflation, like real estate, commodities, TIPS-SEA, those inflation-adjusted treasury bonds. They're all still important, of course.
Yeah,
But the Motley Fool suggests thinking a little bit outside the box.
I like it.
Yeah, they point to senior secured bank loans. These can offer higher yields than traditional bonds. And they provide some protection if interest rates rise.
It's all about diversification. You need a dynamic portfolio strategy, especially in this volatile world. Sticking to the same old playbook just isn't going to cut it anymore.
You got to be adaptable, willing to shift your strategy as you go, constantly searching for those hidden signals that most people miss, kind of like what we're doing in this deep dive.
Exactly.
So to sum it all up, understanding these broader economic forces is just as important as understanding those specific numbers.
I agree.
So let's take a look at what's happening globally.
Okay.
The BIS Quarterly Review. It analyzes developments in international banking and financial markets. Well, it actually provides some really interesting insights.
Oh, yeah?
Yeah, it highlights those complex dynamics between monetary policy, inflation, and financial stability, especially in the aftermath of the pandemic.
Right.
And one of the things that stood out to me is their observation that prudential tightening.
Prudential tightening.
Yeah, so basically policies that are designed to reduce financial risk, well, they can actually help reduce financial stress during times when monetary policy is tightening.
So it's not just about raising interest rates.
Correct.
It's about making sure the whole financial system is more robust.
Exactly. And this ties in with what we were talking about before, that deglobalization. The BIS report also talks about how those interconnected global supply chains can really amplify shocks, just like we saw when COVID hit and everything locked down.
That's a good point. Even if you're only focused on your domestic markets, what's happening globally still matters. Those events on the other side of the world can still affect your economy and your portfolio.
Right. So let's talk about central banks.
Okay.
We've talked about the Fed, but what are other major central banks doing? How are their decisions affecting global markets?
Good question.
Well, the BIS report actually digs into that. It covers their policy rate paths, government bond markets, even the use of those unconventional monetary policy tools we've all been hearing about.
It's interesting to see how different central banks are dealing with these challenges, isn't it?
It is.
And how their actions create both opportunities and risks for investors.
Yeah. So again, it's that reminder that you can't just focus on what's happening in your own backyard. You need to have that global understanding to really grasp those hidden signals.
I agree. And speaking of hidden signals, there's another one that often flies under the radar: the impact of political spending on how corporations behave and how they make their investment decisions.
Okay, now this is where things get really interesting.
Right.
We've got some research here that looks at corporate PACs, those political action committees, and how they influence the relationship between companies and their institutional investors.
Okay.
There was this study published by the National Bureau of Economic Research. They look at how big stock acquisitions by institutional investors actually impact the political spending of those companies.
So the question is, are these institutional investors using their money to influence those companies' political activities?
Yeah, that's what the research suggests.
Wow.
They found that after a large stock acquisition, there was a significant increase in the alignment of political giving between firms and their investors.
Meaning, if an institutional investor has a strong political leaning, they might use their ownership in that company to get the company to support those same political causes.
Exactly.
That's heavy.
It is. And it raises some important questions. How much influence do institutional investors have on politics? Do we need more transparency and accountability when it comes to corporate political spending?
Those are good questions.
Yeah. Investors definitely need to be aware of how their money could be influencing politics. And companies should be open about their political activities and how they connect with their business interests and the interests of their stakeholders.
I agree. It's a complex issue with big implications for both the corporate world and the political landscape, and something we'll definitely need to keep an eye on.
Okay. So let's bring our focus back to the financial markets
Sounds good.
and talk about something that's been making headlines: share buybacks.
Share buybacks. So that's when a company uses its profits to buy back its own stock,
Right.
which reduces the number of shares out there.
Yeah.
And in theory, it should increase the value of the remaining shares.
Right. It's been a big trend lately,
Right.
and there's a lot of debate about what it means for the economy and corporate investment.
Some people argue that share buybacks are a good way for companies to return value to their shareholders, boost their stock price.
Yeah.
Others say it just prioritizes those short-term gains over long-term investments that could help the broader economy.
It's complicated. There are good arguments on both sides.
There are. The BIS Quarterly Review did some analysis on this, looking at trends in share buybacks and what they could mean for financial stability.
And one of the things they're worried about is that these share buybacks, if they get out of control,
Right.
they could lead to companies taking on too much debt.
Right. Which makes them vulnerable when the economy takes a hit.
Exactly. And then it becomes this domino effect that can impact the whole financial system. It reminds us that everything in the financial markets is interconnected. What seems like an isolated action by one company can have ripple effects across the entire system.
I agree. So how do share buybacks fit into the bigger picture of inflation and institutional investing?
Well, one argument is that they could actually be contributing to inflationary pressure.
Oh, really? How so?
When companies buy back their shares, it reduces the number of shares available, so theoretically it could drive up the price.
And if that happens on a massive scale, we could see asset price inflation.
Exactly. And then that spills over into the real economy. Prices for goods and services start to go up. It's this complex chain reaction.
It is. It really shows how closely tied the financial markets and the real economy are.
Yeah. So it's something that institutional investors need to consider, the potential inflationary impact of these corporate financial decisions.
Absolutely. Now let's zoom in on a sector that's been hit particularly hard by inflation.
Okay.
The housing market.
Oh, yeah. Housing has been a wild ride.
It has.
Prices have gone up so much in so many places.
Inflation has been a big part of that, driving up construction costs, interest rates, and just generally increasing demand.
Yeah. It's making it harder and harder to buy a home these days,
Yeah,
especially if you're a first-time buyer.
it is.
And that can have this ripple effect on the whole economy. It impacts consumer spending, economic growth, even social mobility.
Right.
There's a report from Freddie Mac, the Economic and Housing Market Outlook. They dive into all these trends, forecasting future conditions in the housing market and how they might impact the economy.
Interesting. And what's their take?
One of their key takeaways is that affordability is still a huge problem.
Yeah.
Housing costs are expected to keep rising, though they might slow down a bit compared to what we've seen recently.
So it's not going to get any easier for people trying to buy a home.
No. But maybe there's a little bit of hope on the horizon.
Maybe. But institutional investors really need to stay informed about all the factors that are driving the housing market. It's the only way they can make smart decisions based on their goals and their risk tolerance.
Absolutely. Speaking of smart decisions, let's bring it back to our institutional investors.
Okay.
What are the key takeaways for CFOs who are dealing with this inflationary environment?
Well, first things first, they have to look beyond the headlines. They need to dig into the data.
Like we've been talking about, the Federal Reserve's research on interest rate uncertainty, that shows how important it is to understand market sentiment.
Exactly. And the World Economic Forum's analysis of deglobalization, that reminds us to think about those long-term effects of geopolitical shifts and supply chain disruptions.
Institutional investors need a holistic view. They need to consider both domestic and global factors.
They do.
They also need to be adaptable, ready to change their strategies as things change.
Right.
Remember that Deloitte Insight survey about generative AI? It suggests that embracing these new technologies could really help to mitigate those inflationary pressures.
And remember, the Motley Fool's advice about looking at alternative investment strategies like senior secured bank loans, that highlights how important it is to diversify portfolios and to think outside the box.
It's about staying ahead of the curve, spotting those hidden signals that everyone else is missing.
Exactly. And don't forget the human element.
Right.
Even in the institutional investing world, psychology matters. The research on remote work and cognitive biases shows us that even the most data-driven people can be influenced by what they already believe.
So it's a good reminder to stay objective, question everything, and be open to new ideas.
And lastly, institutional investors need to think about how their decisions impact society as a whole. The research on corporate political spending and share buybacks highlights the potential consequences of chasing short-term gains instead of making long-term investments that benefit everyone.
It's a call for institutional investors to be stewards of capital, to make choices that build a more sustainable and fair future.
I agree. So, we often think about inflation as this big national thing.
Right.
But its impact can actually be pretty different depending on where you are in the U.S.
Yeah, that's true. The Federal Reserve Bank of Chicago actually did a whole study on this.
Oh, interesting.
Yeah, and their findings are pretty fascinating. They found that while inflation obviously affects the whole country, the housing sector plays a huge role in those regional differences.
So places where housing costs have, exploded are probably dealing with more intense inflation overall.
Right. That means that institutional investors, if their portfolios are spread out across different regions, they need to be paying attention to those regional differences. It's not enough to just look at the national numbers.
No, you've got to understand what's going on at the local level to make the right decision.
Absolutely. Okay, so let's shift gears a bit.
Okay.
And talk about something that I think a lot of investors overlook, the psychology of inflation. We're not just talking about numbers in a spreadsheet here.
Right.
We're talking about how inflation makes people feel, how it changes their behavior, and how that ultimately impacts their decisions about money.
Yeah, when prices are higher, it's harder to afford the little things that make you happy.
Exactly.
And that can really affect your overall well-being.
It makes sense, right?
It does. And Psychology Today's research actually supports this.
Oh, yeah.
Yeah. Higher prices lead to financial stress, which can negatively impact your mental and physical health. And it can even create this vicious cycle. Inflation causes financial pressure, which leads to stress. And then that stress affects how you make decisions about money, which just perpetuates the whole cycle.
Wow. So it's not enough for institutional investors to just understand how inflation works. They also need to think about its social and psychological effects.
Exactly. Okay, now let's talk about market cycles.
Okay.
Those ups and downs, they're going to happen. But inflation can really impact those cycles,
Right.
creating both opportunities and risks.
Yeah. For example, when inflation is rising, we often see certain assets perform really well, things like commodities or real estate.
Uh-huh.
But other assets, like bonds, they don't do as well. So institutional investors need to anticipate those changes and adjust their portfolios.
It's all about knowing how inflation is going to affect those different types of assets and then adjusting your strategy accordingly.
Right. Okay, so let's talk about a specific type of institutional investor that has become really influential. Sovereign wealth funds.
Ah, sovereign wealth funds.
These are funds owned and managed by governments.
Right.
And they usually invest in a really broad range of assets.
Right.
Stocks, bonds, real estate, commodities, you name it.
Yeah, they're big players in the global market.
Huge players.
A lot of financial power.
The BlackRock Global Outlook report actually offers some really interesting insights into how these funds are handling the current economic climate, especially with all this inflation.
What are they saying?
Well, one of the key things is that they seem to be focusing more and more on those long-term investment themes.
Okay.
Things like technological innovation, the transition to a low-carbon economy. They're looking past those short-term market fluctuations and betting on the things that are shaping the future.
And inflation is a big part of that. It can affect the cost of capital, the profitability of their investments, and just the overall economic outlook. So they have to use some pretty sophisticated strategies to deal with those risks.
Yeah. It's amazing to see how these funds are using their financial muscle to shape the global investment landscape and drive innovation.
Yeah, it really shows how important it is to think beyond those traditional approaches and to understand the forces that are changing the world. And one of those forces is, of course, the evolving nature of work.
That's right. The World Economic Forum has been studying this a lot. How technology, demographic shifts, even changing social values are changing the future of work.
It's a fascinating topic.
And one of the things they found is that the traditional 9-to-5 office job is becoming less common. We're seeing a rise in remote work, the gig economy.
Right.
People are looking for more flexibility.
Right.
And, inflation actually plays an interesting role in this.
Oh, yeah.
It can affect wages, the cost of living, and even whether different work arrangements are affordable or not.
This reminds me of what we talked about before with remote work. It could actually help reduce some of that inflationary pressure because companies have lower costs, and maybe that could lead to lower wage growth.
Yeah.
But then you've got those questions about fair pay, about staying connected with people, about whether it could actually increase inequality.
It's complicated.
Yeah.
But it's something that institutional investors need to watch closely because it's shaping the future of work and the whole economy.
Absolutely. And speaking of the future of the economy, let's talk about government spending.
Okay.
And its potential impact on inflation. There's this idea that when governments spend more than they take in through taxes, it can lead to more money being printed.
Right. And that could fuel inflation.
Yeah. Economists have been arguing about that for decades.
They have. The Urban Institute did some research on this, analyzing the cost of economic security.
And what did they find?
Well, their research suggests that to really make sure everyone in America is economically secure, we'd need to invest a lot more in things like healthcare, education, and social safety nets.
So that means more government spending.
It does.
Mm-hmm.
But their argument is that it could also lead to some really positive long-term economic benefits, a more productive workforce, less inequality, things like that.
So it's not that government spending is always good or always bad, right?
Not.
It depends on how it's used and what the long-term effects will be.
Exactly. And that's something that institutional investors need to figure out.
Right. Assess those potential impacts and then make their decisions based on their goals and their risk tolerance.
Okay. Now let's focus on a specific area of government spending that's been pretty controversial. Its role in supporting technological innovation. Yeah. Governments have always been involved in funding research and development.
Right.
Especially in things like defense and healthcare. But with all the advances in AI and other technologies, there's this debate about whether government should be doing even more.
And this is where the IMF's research on AI comes in.
Oh, yeah.
Yeah, they've looked at the economic impacts of AI and how it should be regulated. It provides a really interesting perspective on this whole debate.
Interesting.
They highlight the incredible potential of AI to change the economy.
Right.
New industries, higher productivity, maybe even solutions to things like climate change.
It's exciting.
It is. But there are concerns too. Jobs disappearing, economic power concentrated in the hands of a few,
Right.
and the need for ethical guidelines to make sure AI is developed responsibly. These are complex issues and there's no easy answers. But these are things institutional investors need to be thinking about.
Yeah. AI is going to have a huge impact on investment decisions in the years to come.
Absolutely. Which leads us to another important aspect of institutional investing, understanding the rules of the game.
The regulatory landscape.
Yes. Governments have a lot of power to shape those rules for businesses and investors.
Right. And the IMF's research on AI regulation really emphasizes how important government intervention is going to be in this area.
Governments everywhere are trying to figure out how to encourage innovation while also dealing with those potential risks we talked about.
And those decisions, they can really impact investment opportunities, how profitable businesses are, even whether certain markets are attractive to investors.
Absolutely. So institutional investors need to stay up to date on all these regulatory developments
Yeah.
and try to anticipate how they might change things.
Speaking of things that can impact investment decisions, we can't forget about social and environmental considerations.
Right. ESG investing.
Exactly. ESG stands for environmental, social, and governance. It's this approach to investing that doesn't just look at the financial returns.
Yeah.
It also considers the impact of investments on the environment, on society, and how companies are run.
And inflation can actually make those social and environmental challenges even worse. Things like poverty, inequality, climate change.
Right. When energy prices go up, low-income households are hit the hardest.
Definitely.
And extreme weather can disrupt those supply chains, damage infrastructure. So institutional investors who are using ESG principles need to really think about how inflation could affect those investments and the communities involved.
It's about recognizing that you can actually aim for both financial returns and a positive impact on the world.
Absolutely. So as we're going through this deep dive, a key theme has emerged: adaptability and resilience in an increasingly uncertain world.
We've been talking about how inflation, deglobalization, advances in technology, and changing social values are all making things much more complex and unpredictable for investors.
And to deal with those challenges, institutional investors need to be able to change their strategies as they go, be open to new ideas, and build portfolios that can weather those economic storms.
We need to go beyond those old ways of thinking about investing. We need a more dynamic and forward-looking approach.
Right. And that means you need a deep understanding of how all these forces are connected. You need to question what you think you know, and you need to be committed to constantly learning and adapting.
I agree.
So to wrap up this part of our deep dive, it's clear that institutional investors are facing a lot of challenges, but also a lot of opportunities in this ever-changing landscape. So welcome back. We've covered a lot of ground, everything from global trends to, the nitty-gritty of figuring out those hidden market signals. But before we finish up, there are a few more things I wanted to touch on. I think you'll find them pretty valuable.
Yeah, for sure.
Okay, let's talk about stress.
Stress.
Not our stress, well, maybe a little bit, but the stress that we're seeing all across America right now.
I see.
The American Psychological Association, they do this Stress in America survey.
Right.
It gives us this really interesting picture of how different things that cause stress, including inflation, are affecting people's lives.
Yeah, and it's not just about financial hardship. It's this broader sense of collective trauma. After the pandemic, the social unrest, all the conflict in the world, climate change.
It's a lot.
It's a lot for anyone to deal with.
Yeah. One of the things that really jumped out at me from that survey is the data on parents.
Oh, really?
They're reporting much higher levels of stress than before the pandemic.
Yeah.
Even chronic illness.
Wow.
Yeah. And a lot of their top concerns are money worries, family responsibilities, the economy.
It's a good reminder that all this stuff we're talking about, these economic trends, they're not just numbers on a page.
Right.
They have a real impact on people's lives.
Exactly. And this goes back to what we were talking about earlier, that psychological impact of inflation.
Right.
When people are stressed, anxious, it affects their judgment.
Yeah.
They might make financial decisions that aren't really in their best interest.
That's something institutional investors need to keep in mind.
Yeah.
You can't just focus on the numbers. You got to understand how people work, how emotions play into everything.
Okay. So there's another interesting thing from that Stress in America survey that I wanted to mention, the data on discrimination.
Oh, right.
They found that Latino adults were more likely to experience different types of discrimination compared to white adults.
Huh.
And the survey also highlighted how many people, no matter their background, don't feel comfortable talking about these experiences.
Especially when it's about stress related to discrimination, it shows how hard it is to create a truly equal and inclusive society.
It does. And that brings us to our final thought as we wrap up this deep dive.
Okay.
Remember how we talked about how remote work could potentially help reduce inflation
Yeah.
and how it could create a more flexible workforce?
Yeah.
Well, could it also help to create a more inclusive society?
Interesting question. Could remote work, by breaking down those geographical barriers and offering that flexibility, create more opportunities for people from different backgrounds?
Right. Could it level the playing field and maybe even help reduce some of those inequalities we see in the data?
That's a good question. It's complex, of course, lots of things to think about, but definitely worth exploring.
Absolutely. And I think it shows how connected everything is. Inflation, those market signals, technology, social trends, they all kind of weave together in ways that we're just starting to understand.
We've learned a lot today, but as always, I feel like we've just scratched the surface.
It's true. But hopefully we've given you some new insights, some new questions to think about, maybe even a new appreciation for just how complex the world really is.
That's what the deep dive is all about.
It is, helping you stay curious, question everything, and give you the knowledge you need to thrive in this crazy, ever-changing world.